Today, I'm going to talk about why everything in retirement changes when you have a pension. If you're new to the channel, hi, I'm Julia, certified financial planner and managing director of a retirement planning firm. And after years of advising retirees, I've noticed that people often underestimate the impact a pension can have on their retirement plan. Then, when they finally decide to retire, they face various surprises that could have easily been avoided. So to make sure that you avoid these pitfalls, I'm going to review the most important considerations, as well as a few examples to help you evaluate your own pension. So let's get into it. For those of you fortunate enough to have a pension, you know that it's a source of guaranteed income that you can't outlive, much like Social Security. You'll typically have several options in terms of how you take the pension. Most of the time, you can opt for a lump sum, or you could get a joint and survivor monthly payout at 100%, 75%, 50%, sometimes 33%. You can take a single life pension that will die with you, or for a period certain, like 10 or 20 years. There's merit to taking the lump sum, and believe it or not, there's equal merit to taking the pension. It all depends on your financial situation and requires proper analysis to make the best decision. And this is a question we get all the time in our practice, right? Should I take the lump sum or the pension? And the answer, as you might imagine, is not one size fits all. Generally, though, the more you have in your nest egg, the less you need that monthly pension. Though it doesn't mean you should rule it out entirely, but that's common sense, right? The more you have in your nest egg, the more risk you can afford to take. And taking that lump sum and investing it in the stock market is certainly a risk. And that's typically the other argument we get. So why would you take the monthly pension when you can get a higher average return in the stock market? I'm sure many of you watching this video have that argument. And the main issue with this argument is that you're not comparing apples to apples. A monthly pension, as long as it's insured by the PBGC, is guaranteed for your life expectancy up to a monthly amount, which in 2025 is $7,431.82. And this is for a 65-year-old under a single employer pension plan. The PBGC, or the Pension Benefit Guaranty Corporation, is a U.S. government agency that insures private pensions for roughly 31 million workers and retirees. You can check with your employer to make sure that they have this coverage so that you can rule out the argument of, what happens in the future if my employer goes belly up? For example, if your pension is less than that $74.31 per month and your employer does have that PBGC coverage, you're going to receive your pension for your life expectancy regardless of your employer's future outcome. On the other hand, your performance in the stock market or the income you're generating, unless it's using treasuries, is not guaranteed. So sure, the 50-year average return in the S&P 500 is 11.48% per year. But that's an average, and that's not what happens in reality. What happens in reality looks like this. Most years are up to some degree, and every 5 to 10 years we'll get a really big down year or a couple down years. The issue with taking your lump sum and buying an index fund like the S&P 500 to provide income is that you're subject to what's called the sequence of returns risk. If you happen to retire just before or just after a market crash, your chances of running out of money are exponentially higher than someone who retires during a bull market. So sure, will the index fund outperform the pension or the private annuity over the long term? Most likely. But again, you can't rely on those returns for income. And depending on what the market's doing when you retire, you could end up out of money in your 80s. Now, you don't have to take the lump sum and buy stocks. You can always take the lump sum and purchase a private annuity instead. So why would you do this? Well, the biggest gripe we hear about pensions from our clients is that if you or your spouse die, your heirs are left with nothing, right? That lump sum goes back to the company you worked for. If you instead take the lump sum and purchase a private annuity with a joint life income and a death benefit, you can still cover your spouse and your kids if both of you, God forbid, die early. For example, Bob's 60, Linda's 59, and they have the following pension options. They have a lump sum of $280,000 available, a joint life and 100% survivor monthly pension of $1,200, right? So if the husband dies, Linda's still going to get that $1,200 per month, a joint life and 50% survivor monthly pension of $1,310 per month. So if Bob passes away, Linda's only going to get half of that. And lastly, a single life pension for $1,500 per month, and that one dies with Bob. So, what should they do? Well, they're not old enough to pull Social Security yet, and they have no other source of guaranteed income. So, they determine that they want something fixed and guaranteed to rely on. Their 401ks and brokerage accounts are in stock and bonds, so a fixed source of income would be a really nice complement to their investment portfolio. They know they want 100% survivorship to protect Linda for several reasons. A main reason being Social Security, because remember, when one spouse dies, the other is only left with one check, and it's the higher of the two. And we also know that expenses don't get cut in half when one spouse dies. In fact, expenses usually decrease by just 25%. So losing one Social Security check is bad enough. They don't want their other guaranteed source of income to disappear too. So the pension will pay 5.1% on the $280,000 lump sum for life, or $1,200 per month. We then ran some private annuity quotes to see if anyone could beat this pension, and we found the following top option. They can get $1,350 per month joint life, just like the pension. Plus, if they both die early, whatever's left in the annuity will pass to their daughters. So this is a win-win, higher income plus a death benefit. Furthermore, when you retire has a lot to do with how you should take your pension. For instance, if you're under the age of 59 and a half, unless you have several other sources of income, you may want to opt for the monthly pension instead of a lump sum. One, because you have a long time until Social Security can kick in. And two, you can't pull from a private annuity until age 59 and a half, so that's out. And three, pulling from an IRA before 59 and a half isn't impossible, but it is cumbersome because you have to use the 72T rule, and plus whatever you invest isn't guaranteed for life unless it's in a treasury or, a private annuity. So too often folks don't realize this, and they actually overlook how their pensions could enable an early retirement. Pensions provide a bridge between early retirement and Social Security that cannot be replicated by private annuities, the stock market, or even bonds. As I said earlier, many people believe that the lump sum is always better than the monthly pension, but that's just not the case for most people. The person who should always take the lump sum is the person who has more than enough money. And when I say more than enough, I really mean it. If you're offered a pension, but you have several $1,000,000 and it's diversified tax-wise, let's say you have some pre-tax, you have a good amount of Roth, a good amount of brokerage accounts, and your expenses are well within your income guardrails, you can take that lump sum and invest it because you can afford to take that risk. As I said earlier, the more you have, the less you need a guaranteed monthly income payment. You can start to see that these decisions that you make around your pension have great impacts on your retirement plan, for better or for worse. But if you don't fully understand how all of these parts affect your retirement future, and you're just making decisions based on general information, you could be putting your savings at risk. In my experience as an advisor, this is one of the reasons I see most plans fail. So to make sure your plan is 100% on track, I created a video that you can use to strengthen your own retirement plan. To watch it, just click the first link in the description, and let's get back to the video. Okay, another issue I see that many take, or another issue I see that many have, is that they take the single life payout instead of the joint life, even though they're married. So to refresh, a single life annuity has a higher monthly payout, but it dies with you. Just the other day, I ran a stress test for a very successful couple in their late 40s, early 50s. The husband has a large military pension, about $75,000 per year. But when he dies, his spouse will only receive $5,000 a year. So as you can imagine, when I stress tested an early death for him at 55 and 60 years old, his wife will have to completely change her lifestyle to account for this lost income, even though they have a really nice nest egg built up. Remember, to create $75,000 a year, you need about $1.5 million. There's no doubt in my mind that the husband should have chosen a different option, but these decisions are irrevocable, which is why you need to thoroughly analyze your options before deciding. So let's walk through the decision-making process using an example. Meet Kevin and Lynn Price, Florida residents who just retired. They're both 57, and we're going to use a life expectancy of 95 years old. They have two kids, Candace and Michael. Their base expenses are $80,000 per year, and they want to leave each child $250,000 minimum at their death, so that's a total of $500,000. Their investable assets are as follows: a joint savings account worth $100,000, a joint brokerage account worth $95,000, Kevin's traditional 401k worth just over $1.1 million, and Lynn's traditional IRA worth roughly $400,000, so they have a total of about $1.7 million. They also have a paid-off home worth $850,000. Under income, we can see their Social Security benefits if they both wait until full retirement age, and underneath, we can see Kevin's annual pension amount if he takes the joint and 100% survivor benefit, which is $36,000 per year or $3,000 per month. This pension does have a cost of living rider at 2% per year. He also has the option of taking the lump sum, which is $500,000, which we'll be testing in just a little bit to see which option makes the most sense for them. So to be clear, he's getting a joint payout percentage of 7.2%. And I'm just using the rate from the last pension I analyzed, so they really can be very good. Obviously, your rate may not be the same, which will affect your decision. Again, they want to spend $80,000 per year in base expenses, and at an advanced age, or their age 80, so think no-go years, their expenses will reduce to 70% or $56,000 in today's dollars. These expenses will inflate at 3% per year. They also want to travel, and they estimate that they'll need $15,000 per year for the first 10 years of retirement, and then half of that, or $7,500 per year, for the following 10 years. So this brings their total expenses this year to $95,000. They're in Florida, so the software will estimate their federal taxes owed each year. And of course, they're no longer saving, right? They're retired, and they do not have life or long-term care insurance. So now let's run some stress tests. If you've watched my videos, you know that I always stress test against sequence of returns risk using our software Riskalyze to simulate another 2007 to 2009 Great Recession. So using that crash occurring next year, plus all of the foundational information that we reviewed earlier, including them taking that pension at 100% survivorship at $36,000 per year, right? Not the lump sum. If they live to age 95, they have a 98% chance of success. So in our practice, we look for an 80% chance of success, so they can actually increase their base spending from $80,000 a year to $100,000 per year. And remember, this does not include their travel. But what if they instead take the lump sum and invest it in a balanced manner, earning 7.5% per year on average? So please note that when you take the lump sum, you roll that out to a traditional IRA, right? So every dollar you pull is taxable as ordinary income, unless you decide to convert that, and that's just like the monthly pension. Okay, so if they take the lump sum and they live to age 95, they have an 89% chance of success, so lower than with the pension, but still above what we look for. So for an 80% chance of success, they could increase their base spending from $80,000 per year to $84,000 per year. So that's a $15,000 difference from what they can spend if they take the joint monthly pension. So that's strike one against the lump sum, but what would happen if they both need long-term care between ages 85 and 88 before passing away? Remember, they don't have long-term care insurance or life insurance. So with the pension, they have a 70% chance of success, right? But if they both need long-term care, they would sell their primary residence. So when they do that, their chances of success increase to 79%, which is close enough to that 80% we're looking for. Now, if they take the lump sum instead and need long-term care, their chances of success are just 42%. And even if they sell their home at age 85, they still only have a 54% chance of success. So to get to 80%, they'd have to reduce their base spending by $15,000 per year, whereas taking that monthly pension allows them to, one, spend what they had planned and have a good chance of self-insuring for long-term care, not to mention meeting their legacy goal of $250,000 per child. So after this analysis, it makes it really easy to take the joint monthly pension. Now, I know some of you are saying, oh, well, I'm going to earn more than 7.5% in a balanced portfolio. Or, I have a fund that has a dividend of higher than 7.5%. By the way, we have those too in our income portfolio. We know they exist. But again, none of that is guaranteed. I don't mean to scream from the rooftops, but it needs to be said. The pension is guaranteed. So if Kevin and Lynn were to take that lump sum and, they're still taking that much higher risk than if they were to take their pension. So now you know why everything in retirement changes when you have a pension, and you have some points to consider before making your own decision. However, it's important to note that having a successful plan goes well beyond accounting for a pension. There are many other factors that affect your plan's success rate that I don't have time to cover in this video. The only way you're going to make sure you're making all of the right decisions is by understanding exactly where you stand for retirement and making those changes accordingly. So to remove any second guessing as you prepare for this critical moment in your life, I put together a free retirement optimization video. In this video, I go over the exact system I use with my own clients to plan for a long and healthy retirement. To watch it, just click the first link in the description, and I'll see you next time.